maybe we could see if I could get some energy going here. So just a very random question. How many of you are into photography? If you don't mind, if you could raise your hand. Of course. Anybody else who has a vivid interest in photography? I mean, we all carry cameras in our pocket every day, correct? So lovely. If you don't mind, just keep your hands up. Okay, that's great. That's great. Just if you don't mind, just keep your hand up, sir. Yeah. How many of you are interested in photography and in wildlife photography specifically? And it could even be the cat at your home, a dog at your home, but who's interested in photography and specifically wildlife photography? So you, sir, correct? Okay, lovely. Sorry, I'm going to push the two of you under the bus. Okay, so forgive me for this. Do you recognize this? Okay, so vivid interest in photography, wildlife photography, but you don't recognize this. Doesn't matter. Anybody in the group, do you recognize this? This sort of creature, animal, whatever you call it. Great. How many of you recognize this? Lovely. Okay, now that we've discussed unicorns, let's discuss valuations. Okay, let's just get this out of the way. Yeah. So this is our topic, correct? Valuation and finance. And I just thought that maybe before we get into a lot more details, we'll just take out the whole unicorn buzz out of the way. Okay, I'm in the tech world, but I'm a very old school person. And I genuinely believe that there's a distinct connection between value creation and valuation. And I'm not an expert on valuation. Okay, so my rather focus would be on how do we create value, and hopefully that leads to valuation. Okay, and don't ask me why does a stock go up every day, come down every day, why markets guided by 5, 10% in a short period of time. Okay, it's only some people who are fluent in English who can't explain anything else, they're the only people who can explain that. Okay, so it's going to be a little less about valuation, more about value creation. And when we speak value creation, this is honestly what I studied. Okay, way back in school, I'm sure everybody hopefully is in some shape or form seen this. Okay, this is the popular DuPont model. Okay, and the DuPont model went down to saying that it is really about returns on equity. And then broadly, there are 3 levers to the returns on equity. Okay, one is, can you just grow your business faster? Okay, B is, can you make it more profitable? Okay, and C is, how do you gear your business, correct? That was effectively what it spoke about. So can you expand your profit margin? Okay, and therefore grow and get profitability? Can you have higher asset turn, and therefore you are far more capital efficient? Okay, and then is, how are you financing your capital? Okay, just sort of very simply, that is how returns on equity come about. And if you have higher return on equity, then effectively what you're saying is that you're outperforming cost of capital, and you're outperforming cost of capital, obviously you're creating value. Okay, very, very simple way of thinking of life, but that's the reality of what we do in business, correct? I mean, most of us as finance people, in some shape or form, are helping decisions to be made so that the business can grow faster. Okay, that's the way we contribute to the top line. Or we are working on driving cost out of the business. More often than not, whenever it is a cost conversation, my CEO founder looks at me, okay, and therefore I think it is almost given that this is a profession, okay, which has the skills to sort of get into the details and drive down cost out of the organization, and therefore we create margin. I have spent my entire life worrying about working capital, okay, because it is a huge cash burden in the business. Okay, who doesn't know out here, how do you calculate days on hand, receivable per day? We've done all of that maths, but effectively what are we doing? We are reducing the amount of capital invested in the business, and as we reduce the amount of capital invested in the business, on the lower capital or on the same capital, if we can get higher sales, okay, we are again creating far more returns on the equity. Yeah? And then really the third lever here is about cost of equity. We all understand is higher than cost of debt. And therefore, if you were to gear your business correctly, okay, then again you are going to effectively reduce the amount of more costly way of funding your business, and therefore you're going to create higher ROE. Yeah? So we've learned all of this in school, and as I said, in the tech world, but I'm still a very firm believer of this. This is, however, my life has progressed. Okay, and somewhere in the early 90s, I qualified as a chartered accountant, started working with Hindustan Lever. I just spoke to you about valuations which were very cash linked. Okay, ROE was all about the returns and the cash that the business is throwing out, and therefore valuations were about discounted cash flows, correct? And as life has evolved, okay, and as I have sort of looked back at the last sort of 20, 25 years since I qualified as a chartered accountant, okay, if you were to just look at the bottom row out here, okay, then we've thought about business valuations as discounted cash flows. We speak about business valuation on price earning ratios. So what we effectively did is that cash को हटा देते हैं, सिर्फ profit की बात करते हैं, correct? That is what happened when it came to price earning ratios. Then valuation started getting linked to EBITDA, which means हम करें profit को भी छोड़ दो, उसमें से interest हटा दो, depreciation हटा दो, okay? उस पर business को value करते हैं. Then we said, you know what? It's linked to revenue. कितना sales multiple है? So profit बना रहे हो, नहीं बना रहे हो, फर्क नहीं पड़ता है. Okay, revenue per business को value करेंगे. Okay, and then we are all sitting here in Bangalore, and then came this very funny terminology called as GMV. Okay, revenue भी नहीं है, कोई आके मेरे प्लेटफॉर्म पर से खरीद के लेके गया और उसके मल्टीपल पर वैल्यू करो. Okay, it is baffling. Okay, I just spent literally 3 minutes explaining to you what ROE is about. Okay, and in the 25 years of my career, okay, world has gone from hard cash-based valuation, okay, to softer GMV-based valuation. Okay, and it. Sorry? I don't know. I honestly don't know, okay, because he's valued Zomato, correct? And Zomato, at least until now, doesn't produce outside of this anything else. So I honestly don't know, yeah. But that is really what has happened. And I think as a finance professional, someday I'm baffled, okay, and I have some amount of empathy with what's happening in the world. And here is sort of my thought process around it. Okay, I'll just throw a few numbers for all of us. And 2 of these organizations I worked with. The third one I have traveled in. Okay, but Vedanta, okay, is a $19 billion corporation. Okay, makes profit. Okay, grows, has tangible cash flows. Okay, and is valued at less than 1 multiple to top line. Okay, 13 billion to a 19 billion top line organization. Unilever, $66 billion, $100+ dollars of valuation. Okay, again grows 9%. Okay, very exciting 22% plus EBITDA margin, and creates close to $6 to $7 billion of cash flows every year. Okay, and then Uber. Okay, the $8 billion is the revenue, but Uber actually speaks about the $31 billion, which is the GMV. Okay, actually loses money. Okay, and is valued 10x of top line. Okay, that's the mystery. So we just spoke about what has happened conceptually. I just brought some numbers for all of us. Okay, and here is how I tend to relate to it. Okay, it's my philosophy, and I'm just going to share it here. Maybe you accept it, maybe you don't accept it, but this is what has been happening in the world, correct? If we were to just sit back and ask ourselves the question, as human being evolved, okay, 9,000 years back or 12,000 years back, in 9000 BC, we had the agriculture revolution. Okay, 18th century saw the industrial revolution, and 1980s is when internet became commonly available to most of us. Okay, I think it was more in 1990s it started getting more popular. In 1980s, probably it was still more with the military organizations, which is where the innovation came from. Okay, and the point I'm trying to get to is, okay, it's a revolution that we are living through. Okay, the way industrial revolution transformed life, and as I qualified, it was almost shifting of gear happening. The world was moving from an industrial revolution stage to a digital revolution stage. Okay, and my professional life, I have been the guinea pig of the digital revolution coming about. Okay, and therefore I think the whole world is today sitting in a space where there is a high amount of optimism, and we might leave out the current macros. But in general, if you were to think about technological disruptions which could come our way over the next 20, 30, 40, 50 years, then you are probably sitting somewhere, okay, at the starting stage of that. And which is why some of the concepts like GMV-based multiples, okay, is what businesses are being valued at, because there is a belief that somewhere the way we as human beings will live will be very different. Yeah? And therefore, the reason I'm bringing all of this topic out here is as finance professionals, rightly so, okay, we are very particular about cash in the business, and we are very particular about margins in the business. Okay, and therefore, we have some amount of skepticism. I have some amount of skepticism, okay, when businesses get valued on a little more fluffy concept like GMV. Yeah? But at the same time, okay, my submission here is, okay, it's a mega transition which is happening. Okay, and in that mega transition, if you are not on the digital bandwagon, okay, your business is going to be somebody who is going to fall prey to that. And as a finance professional, we have a role to play in that. Just to pick up 3 examples again out here. Okay, I've been very specific in choosing what I'm choosing. Pure Harvest is a business based out of Middle East. Okay, it's a business which is using newer technology to change agriculture. Stage 1 of humankind's revolution was agriculture. It is using newer technology to change how agriculture is done. In 2022, it raised the highest amount of money that any startup did in UAE. Okay. Volkswagen, okay, again, old school organization, transforming itself. Okay, we speak about Tesla, but here is somebody who is already world's 3rd largest EV manufacturer. Okay, and TikTok, which is a product actually of the digital ecosystem. Okay, had something like close to 700 million downloads of its app. In 22, it is the highest downloaded app, okay, on Apple Play Store. Yeah? Again, the point I'm making is, whichever part of the industry you are in, okay, to get your business on the right course, okay, it's important that somewhere we adapt what is happening around us, which is the technological revolution. People who are able to do that in agriculture are very handsomely valued and are able to raise money well. Okay, and that is really the sort of thought where I come from. Okay, as finance professionals, okay, it is really for us, okay, to sort of ring the bell in the organization. Okay, that if we want to be on the trajectory where our business enjoys better valuation, where people look up to our business, okay, then we have to be on the same mega trend that the world is heading towards, which could be digital, which could be sustainability, which could be climate. These are some of the mega trends happening around us. This is the way businesses are going to transform over the next 10, 15, 20 years. And today, if we are not on that journey, okay, we will just be left behind. Yep. And this is really therefore what my point is all about. Okay, if it is about improving valuation, if it is about valuation of our business, okay, then really as finance professional, there are 3 aspects. Okay, what's your model? Okay, is your business model one of really in tune with what's the mega trend happening in the world today? Okay, how do you communicate it? Okay, it's extremely important. Okay, I have sat through number of pitch conversation to raise money. Okay, and sorry, no offense to anyone, but young people wearing ties have asked me questions because I have not been very clear in how I'm explaining my business to them. Okay, and it's extremely therefore important as to how do you communicate. And if you understand your model, okay, then really as finance professional, are we driving the right levers in the business? Okay, if the model is one about saying, hey, you know what, we need to get the first mover advantage out here because the idea that we have is really a supreme one, then maybe if you're doing a cost conversation, I think it is just the wrong conversation. Okay, because the first mover advantage is about how can I scale up faster. Okay, and therefore you're just not in sync with what is your model. And therefore what levers are we going to be driving, okay, is extremely important to be in tune with your model. Yeah, so that's really what I had to say. I mean, I think there's an opportunity for all of us to be this and better, okay. But effectively as a finance professional, ROE, great concept, The world is changing. There is a digital revolution happening around us. Every business, whatever business you are in, if you are a produce of 9000 BC revolution, which was agriculture, okay, or the 18th century revolution, which was industrial, or you're part of the native digital ecosystem, doesn't matter. Okay, if you can sooner get onto the mega trends on climate, the mega trends on digital, the mega trends on sustainability, okay, you can substantially transform your business, okay, in the way in which the newer world wants to look at us. Okay, that is effectively the way I think about valuations. Yeah, this is all that I have. Okay, there are still 20 more minutes, and therefore happy to take questions.
So I would like to announce that we'd want to make this an interactive session, so we'd be happy for any questions. You can raise your hand and I'll come around.
Very, very simple question, you know. First of all, thanks for the insightful slides. You know, your model talks about 3 aspects, right? Very one simple aspect, which I have a question is, who do you communicate? Because that is where sometimes, you know, people fail, projects fail. If your ideas are not taken up at the right level, or it doesn't have a right support, it will not happen. You know, irrespective of, you know, how you want to communicate, what your model is, does not matter, right? So how do you see that angle? Like, who do you communicate?
Everyone. Quite honestly, okay, I think if you believe in your idea, okay, create the burning platform. Okay, so that very famous example, correct, when Kennedy went to the NASA Space Center and he asked the janitor, what is it that you do? And the janitor said, I'm working here to put man on the moon. Correct? If everybody in the organization doesn't bite into the idea, you're not going to find success.
No, absolutely. So it has to also, you know, not even like, you know, bottoms up, but top down approach.
Indeed.
You know, everything is required. Sometimes, you know, when you have ideas you take up at management level, you know, there is a blind eye, right? They may not look at it, they may not understand. So I think that is where, if you don't get the right support, right? I mean, whatever your idea is will fail because people are just not understanding, right? But they're not listening.
True. Right? I fully agree with you, and I think maybe the way I would respond to that is be perseverant, quit and go away. Yeah, because if they're still not seeing the picture, you're probably in the wrong place.
Exactly. Yeah. Thanks.
Sorry. Yeah. But
no, absolutely fine. These are the practical problems, right?
Yeah,
I'm sure many people go through.
Indeed.
You know, you come up with wonderful things and your management's like, I'm not able to see this, you know, right? Yeah.
Therefore, be perseverant. But after a point in time, you have to realize that this is never going to work.
See, sometimes, you know, these things get realized when there is an appropriate time.
Sure.
So, for example, if organization is going through some downturn, then they will understand the benefit of, let's say, a proposal. Oh, this was a cost-saving proposal. We are going through downturn. Oh, this is a good option. We never looked at it.
Yep.
Right. So it's a situation sometimes, right?
I see your point.
Yeah. Great.
There's a time for every idea.
Thanks. Yeah.
Sure.
Hey, my name is Balaji. Thank you, Neelesh, for the presentation. My question is actually, when you talk about valuation, right, especially in the investment community, the VC circles, how much of precedence plays a role in the valuation, right? If something new, you know, the idea is new, you can keep persevering, you know, but VCs and the investment community, you know, generally look for precedence, be it in India or outside of India. How much do you think, you know, that weighs over the decision of, you know, the valuation?
No, I think it's a good question. Maybe I will sort of, for all realistic purposes, slice that investor community into maybe 3 parts. Okay. I think there is a community which is the venture capital community. Okay. I think there is a community which is a private equity community. Okay. And I think there is a community which today is almost gone subdued, but which is called as pipe community. Okay. The venture capital community is really about almost untested ideas. Okay, so that community is less about precedence, okay, more about disruption and will this work. Okay, I'm not trying to make a point here that venture capital doesn't necessarily look for reference point, but that's a community which is more open to untested ideas. Okay. The private equity community definitely wants to see businesses and bet on businesses, which is about scaling them up, which means the idea has already worked. Okay, there is a lot of proof of concept. Okay, and it is now about putting money to scale up the business. Okay. And the pipe community is effectively one of saying, you are already successful as a private company. Okay, can I fund you so that you can move from private to public? Okay, and at that stage, effectively, they're backing IPO-ready businesses. Okay, it's not to say that the PE community doesn't do that, but then they're backing more IPO-ready businesses. So I think the reason I'm splitting them down is because if we go and communicate or pitch an idea to somebody who is the pipe community, okay, on a very new concept, of course, they are going to be blind to it because they don't just get it. Yeah. Even for a VC community, a completely untested idea, which doesn't necessarily have a reference point, requires a lot of belief. Okay, even for a VC community, honestly, there is a herd mentality. Right? Everybody is doing electric cars, so the entire VC community is on electric cars. Okay, I think the entire community is moving to AI. Okay, so is there a herd mentality? There is a herd mentality.
Hello. Hi, here.
Hey.
My name is 𝗀𝗁𝗍𝗃.
Hi, Lakshman.
Okay, though I don't want to take names, but to give you a perspective or my question to perspective. See, let us say recent IPOs, Nykaa and Zomato, which 𝗀𝗏 𝗵𝗲 said it could not be more than 44, 48 rupees. And the recent devaluation in 3 levels for Byju's, if you see, no? The valuations have been not on a logic or a strong fundamental base of old school thought like return on capital employed or EBITDA or anything like that. Is it again due to the new business, IoT and new business and GMV concept of subscriber base, number of subscribers, those kind of thing? Typically now the PEs and VCs have learnt that cash is a king, because in the COVID times, there was many things were closed because they did not have salaries to money to pay salaries and nobody to fund it again and again. So in these examples and this kind of situation, of course, valuations have also undergone change now. What was bumper has already reduced, and it is not money no more raining. All the VCs and PEs have also become careful in investing after burning their fingers a bit. Just I want to share your thoughts about these things.
Yeah, so I've seen too many cycles. Okay, I moved into the sort of early stage ecosystem 7-8 years back, and seen macro cycles, mega cycles. It's a valid question. Okay, and I think there is a lot of wealth which has happened, but sometimes I'm going to ask us to step back and ask ourselves the question. Okay, if we go back into the time when the telephone was discovered, okay, could we have built up a business case for it? I'm speaking about the first, Graham Bell phone. I'm not speaking about the mobile phone that we carry in our pocket. Could we have ever built a case for it? Would it ever have shown a DCF which was positive? I severely doubt it. Okay, it's simply because I don't think we ever would have, in our wildest imagination, thought that one day everybody is going to carry a phone in their pocket. Okay, so I don't think there could have ever been a business case for a telephone which required so much investment in laying the wires, creating the circuits, etc., etc. Okay, and therefore this got all funded by governments. correct? Bus services, transportation, early days, air transportation, again got funded by government. We would have never dreamt about the fact that we would want to travel thousands of miles, okay, to go and meet our friends or relatives. Okay, and again, at that point in time, if somebody would have put together a business case for commercial aircraft, okay, I severely doubt those business cases would have ever been positive cash flow business cases. Again, substantive investments came from taxpayers and from governments. Okay, and after a tipping point, as habit changed, okay, some of them then became more commercially possible. Okay, so I think the concern on valuation and the concern on froth and euphoria and valuation is partly right. I don't take away that point. Okay, but I'm going to sit back and again ask the question. Okay, if the idea or if the venture is transformative in nature, okay, it is really difficult for anybody to put any business case, okay, and put their hand on their heart and say this will actually happen. Okay, and in those cases also mega investments have come by burning money. Okay, so that is where I come from. Okay, that's the way I think about it. Now, to take your example, should Byju be valued at whatever its valuation is? Should Zomato have been valued at whatever their valuation was? As I said earlier, I'm not an expert on that topic. Okay, I don't have an answer for that. Okay, but where I'm coming to is that when there is a transformative change, business cases are difficult to build. Okay, and in the past, actually it was the public investment which was making all of that happen. That is now shifted to private sector. Okay, some of it will work, some of it will not work.
Similarly, payment gateways, it's very difficult to, a lot of investment is required. The fintech companies got revalued again, and more companies are coming with the data security and the kind of investments on IT and the development that has to be made for a payment gateway business. Many people, including small banks, if you see, they have exited. They have not taken up those licenses also.
Yeah, no, you're right. I lived out of India and I don't grouch that at all. I would spend 5-6% of the money I was remitting to banks, okay, which I thought was ridiculous. Okay, so I don't grouch that.
Hi, I have a question. First of all, let me tell you that the lunch was great, but in spite of that, you have attracted everybody's attention. So it was so beautifully described.
Thank you. Pleasure.
And like finance professionals, like you mentioned, that we're more comfortable towards historical cost-based valuations rather than future variables-based valuations. So in between, do you think finance professionals or regulatory authority bodies like CA Institute have a role to play in bringing some sense to this madness of future-based valuation, so to say?
It's a good question. If two people are doing a commercial transaction, what is the role of a third person? Correct. That's how I think about it. So I don't know whether the CA Institute should necessarily, or anybody for that matter, okay, India has had a CCI, correct, Capital Control Authority of India, which would decide how much premium can you charge when you issue shares, if you should at all charge premium or not, correct. So I honestly don't know whether there should be a body governing it. My point of view is no. Okay, I would leave it for two adults to value an asset. I think at least when it comes to publicly traded companies, what is important is bad practices not happening, okay, insider trading not happening, okay, leakage of information not happening, deliberately shorting a stock not happening, because out there fundamentally it is the retail investor who's always burned their fingers. Private transactions, there is already a threshold of wealth below which you can't be participating. Now, if you could still use various platforms, but then I think you got to be conscious about what you're doing. But I don't see a role for CA Institute to govern that.
No, my question is slightly different. You rightly described about the governance part of it. I didn't mean that. I meant to say that can we develop models as financial specialists, finance specialists, and regulatory bodies like Institute, can they give models, not governing them, not regulating them? That
I
was my
understood your question. And I think maybe I may have the statistics wrong, but I would like to think that most of the certified merchant valuers are chartered accountants. Not so clear.
Hi Neelesh, 𝗃𝗹𝗂𝗁𝗃 here.
Okay.
So my question is more of, if I want to acquire a company which is not necessarily doing great in terms of growth or EBITDA or anything, but I have some other interests in terms of getting into the market or some synergy benefits that we see. So which of these models would you recommend in order to do valuation of such a company?
I'll sort of take a step before that. And I think it will also depend on the stage of evolution of the company. Is where I would start with. And I understand, I mean, there are more than just the commercial reasons to acquire somebody. So I take your point, 𝗃𝗹𝗂𝗁𝗃. If it is in the nature of a product service organization where the business has been, there are similar other businesses, okay, I would tend to lean towards a cash flow model.
Okay.
Simply coming from the point of view is there are ways of determining the growth trajectory. There are ways to determine the cost of growth, and there are ways of determining the extent of other cost structures. Okay, and in those instances, I would tend to lean towards doing valuations, okay, which are actually based on good old DCF valuation methodology. You could acquire smaller organizations, and we've seen a wave of this, let us say, happening in 2020, 2021, which are D2C businesses. Okay, these were still smaller organizations. They were potentially only successful on one platform. They had not traversed across multiple platforms. The product market fit was not still fully established. In those instances, always doing DCF might be difficult because you're still trying to get a level of predictability on how their cash patterns could evolve. And therefore, you might want to look beyond DCF. In those instances, maybe your option could be to look at what are the comparative valuations for similar type of businesses are commanding, and then come back and see whether it works for you. Even where you would do a good old DCF-based valuation, I think it is always very healthy to look for what is happening in the comparative ecosystem.
Okay.
In some cases, it can give you a bargaining advantages. If for any reason that industry segment is depressed and good deals are not happening there, and if your DCF output is higher than comparative valuation, why give away that money? Therefore, it can give you competitive advantage. In other instances, it could also happen that because there is a lot of excitement in that pocket, okay, valuations are higher, okay, it will give you a reality check, if I could put it that way, to sort of ask yourself the question, if there is so much excitement around this industry, okay, am I being too conservative in building my case? And should I be actually flexing more if I'm very clear that I want to acquire this asset? And therefore, do your good old DCF methodology, but do a reality check looking at what's happening in the comparative ecosystem.
Okay, okay. So you still vouch for DCF as the primary?
Yeah, don't get me wrong. I'm a complete chartered accountant. Okay, fully vouch for that.
Okay, thank you.
Yeah, Neelesh, Ram here. Thanks for the quick, clear session. See, I mean, whenever the valuation or acquisition happens, all the consultants or the owners who wants to buy out, they're very quick or to take a decision, hurry, probably they look at more on numbers and benefits. But I see in my experience, whatever so far, mostly 20-30% only got successful. One of the main reason I see that is the way in which the company who were managing after acquisition, we didn't see that the way in which that had been managed. So there's a big difference in which the companies were managed, but pre-acquisition and post-acquisition. But I don't know how this has been in the valuation. How do you give the space? I mean, it's more of acquisition goes the gut feeling. I mean, at the end of the day, whatever recommendation goes, but take a decision on gut feeling. But it doesn't fit it. I mean, I don't know should we take care of, maybe it's more of a due diligence point, I don't know, but how do you relate that in terms of, as you said create value, but how do you see this space of, fitment?
I think it's a very interesting question and a very good one also. This is how Unilever would tackle it. Okay, and at Unilever, again, we were very clear it's a DCF-based valuation. Whenever we looked at a potential acquisition, the way we would do it is it was 10 years of projected cash flow, and then beyond 10 years, it was based on simply using a sustainability factor of future cash flows. That is the way we would project out the cash flows. The projections of cash flows obviously was done by folks who understood that business well, along with the finance professional. Then you would, of course, do the healthy finance thing of doing a DCF analysis of that. So you projected them in nominal money, and then you do a DCF sort of to bring it back to the current value of the business. When you do the DCF, okay, there is the discounting factor that you're going to use. Okay, that's the factor that you'll use. At Unilever, there were broadly two components to that. Okay, one component was my WACC, my weighted average cost of capital. Okay, importantly, there was a factor also of what is the risk-related premium I want to discount it by. Okay, and therefore for Unilever, I don't think this is very confidential and it's very old data also. At a global level, cost of capital would be low single digits. Okay, it's global cost of capital, but the discounting factor would typically be high single digit, because what you have effectively done is you put that risk premium into it, and therefore you have protected against the cash flow projections, which may derail for multiple reasons, including the point that you made, the earlier management was probably closer to the business, etc. So that's the way Unilever would tackle it, just deliberately discount it steeper to provide for that risk.
Okay. This is 𝗀𝗵𝗲 𝗂𝗏. I just want to ask you one question. Is valuation is something about perception? Because you look at the valuation which is on the listed space, correct? Which is on the PE multiples, and it keeps on changing industry to industry. Within the industry, again, if you see, there are high number of multiples compared to some of the old peers gets very low multiples. Secondly, I think market always wants some flavor. If you look at the history of even the stock market, okay, every time you will find one industry or one particular sector outshines the others, and where the money start chasing and the valuation goes, and eventually it peters out, and then something else comes always. So is the valuation really a benchmark for that kind of a thing? I mean, I just want to.
No, I think maybe there are two parts to the question, correct? Is valuations a perception, and why is it that different organizations enjoy different P multiple? I think the second part of the question, why is it that different organizations within the industry, across the industry, have different P multiple? I think there's a good business economic reason to it. Okay, if your business is just far more oriented towards growth, if it is going to create more cash flows, naturally you need to have a higher P. It's very simple. If you do any DCF calculation, obviously a fast growing business with a better margin trajectory has to command a better valuation. So I think that hard part of the question in my mind is fairly straightforward. Different industries deserve to have different P multiples, deserve to be valued differently, and organizations within an industry which have better strategy, which have better implementation, far better execution, should take a premium. So I have little doubt about that. Is it a perception? Yeah, I mean, it's like, is my lawn more beautiful than my neighbor's? Is my wife more beautiful than my neighbor's? Yeah, valuation is a bit like that, isn't it? I mean, finally, as I said, it's a commercial transaction between two people. Somebody has a greater need, somebody has a lesser need. that interplay will always come in. Are there other factors which disturb things if you were to ask that question at a more macro level? I would think so. I mean, if the world's biggest economy goes and pumps in 10% of its GDP by printing in money on the back of COVID, okay, it's going to create flooding of money in the entire global ecosystem, isn't it? I mean, followed by US, almost every other country went and printed money. You're printing money when product is not there. Obviously, it's going to create a situation where everybody is flushed with money. And when everybody is flushed with money and cost of capital is zero, I don't know what is perception because I'm getting everything for free. Correct? My discounting factor, my WACC is zero. If my WACC is zero, valuation is infinity. I don't even know why were people, actually I thought any number is lower than infinity, correct? So people only underpaid if you're getting capital for free. So I think there are distortions, okay? There is nothing we can do about distortions.
That's what my question was. Perception, basically, perception keep on changing. So one industry you saw, example, financial industry, in 90s, where the flavor of the market, then that has gone. Then the another industry, which is now infrastructure industry, which came. Then suddenly it was an IT in 2000. So it keeps on changing the market pattern. What I wanted to say that.
That's true. I think that's true. But I think the question, I would go back to the point I made, even if you're an agriculture industry, okay, if you understand the mega trends, and if you're able to transform yourself in line with the mega trend, okay, you can actually have great valuation. I mean, why are we looking at that? In my mind, the best example would be Reliance, isn't it? It was a oil exploration and a textile industry. Okay, from there it has transformed itself to become India's potentially biggest retailer, India's potentially biggest mobile service provider, India's potentially biggest digital service provider. Okay, all of that has happened in our lifetime, correct? So I think if Reliance would have continued to be the textile industry that it was 30 years back, I don't think anybody would have, Mukesh Ambani would now have been the richest individual in Asia, correct? I think that's transformation, okay, which has made it possible. So yes, it is, changes will always happen around us. Are we in tune with the change happening with us? Are we ahead of the change which is happening with us? We will command better valuation. You good? Thank you. Yeah. Thanks, everybody.